Hi everybody, this is Phillip Guan, CPA, and welcome to this classes. And this class is holding by me for the purpose to teaching each and everybody how tax and money works. And also, so for 4 separate purposes. Number 1, learn how that works, apply to yourself. And number 2, maybe you're interested to become part-time or full-time to do accounting or tax service, so that you learn the basis and you get the right answer. I mean all the license. So by doing so, you get yourself to get your foot into this field. Okay. So now the third one is you may actually would like to become the franchise business owner. For example, if you like this business and you work, you get training, you get all the good stuff. At the end, you also feel, you know what? This is so cool. I want to own this kind of business. So you can own a franchise business from our CPA firm, or you can open your own business and under your own name. And nevertheless, after the 19 years to have my own business, August 18 is the 18th anniversary of my CPA firm, Phillip Guan CPA. So I would like to share what I know with you. So now, the first thing I want to tell you is, well, without making money, there's no tax need to talk, right? So first, let's talk about money first, and then we talk about tax. Okay. So now the first one I would like to talk about is how actually make money for each and every one of us. Well, there's only 2 ways to make money. Number 1 is use ourselves to make money. Number 2 is use the money to make money. In the first one, use ourselves make money. In the very normal easy way is you work for a boss. A boss cut you a check and pay you W-2, right? Now, before the money give it to you, actually the boss helped you to pay all the payroll tax, and then the boss also pay, as well as your withholding. So for example, you make 120,000 gross, so you're supposed to get 10,000 per month, right? But your paycheck doesn't show 10,000 like that. You have like did and cut all the way until you get that. And that's what the taxes are. So Uncle Sam get his cut. Uncle Sam get his cut for 2 parts of it. So the number 1 part is the payroll tax. The payroll tax, the boss pay half, you pay half. And then when you bring the W-2 get to your home, and you either bring those to the CPA or you use your TurboTax to doing it, and then you calculate it to do quote unquote called income tax, right? So now the second thing I would like to tell you is you actually have the opportunity to own your business. Like myself, I own my CPA firms. So now nobody cut a check to pay me as an employer. Of course, I have all my clients are my bosses, right? So I want to, so by doing this way, the client give you money, let's say 10,000, that's a 10,000. And you do not pay the payroll tax yet. So by the time you fill your own tax return 1040, guess what you need to do? You need to in the schedule C like cat, right? And then you do a gross revenue, gross income, 120,000, and you minus rent, minus all the necessary expenses, and then you net to the point. For example, you net of 80,000, just for example, and then you're going to pay income tax based on the 80,000 for 2 taxes. One is income tax, like the W2. Guess what's the other one? Iris, what is the other one? You have to unmute yourself before you can say it. You have not been okay. Iris, the left hand side, or anybody knows, when you own your business, besides the pay income tax like W2, guess what kind of tax you need to also pay? If you know it, you can unmute yourself. You say your name.
1099C.
Okay, say one more time.
It's
Iris.
109. It's 1099C.
Yeah, it's 1099. You report in Schedule C. You pay income tax like W2, but besides that, you need to pay Uncle Sam one more tax in your 1040. That is called self-employment tax. Self-employment tax. That is 15.3%. A lot of money. 15. If you net 80 times 15%, you just put the 15 to E. You say that's a lot of money. So it's income tax on top of income tax. Now, is there any legal way in this situation that could legally can actually save tax? Yes, you do. You actually can incorporate this business, not as a sole proprietorship. You can do it as a corporation, like S corporation. So you pay yourself a reasonable amount of W2. And then besides that, you get a K1 income. Well, the W2, you pay, because the W2 by itself, you pay payroll tax. But the K1 income that you get it from your own corporation does not need to pay payroll tax, nor need to pay self-employment tax. So by doing so, you legally save your income tax in your 1040. Okay, to recap, use yourself make money is 2 major ways, but 3 separate ways. W2, just fixed. Work it by yourself in Schedule C, pay income tax and self-employment tax. Incorporate your business as an S corporation, and you need to pay yourself a reasonable amount of compensation, your W2. And then you get a K1. If you compare with Schedule C and S corporation is legally save more tax than sole proprietorship. All right, now let's switch topic. We were talking about to make money by 2 different ways. One is use yourself make money. We just finished that. And then the second thing is use some money to make money. Now, make money, that means the money is already paid tax, like the money in the bank. The money in the bank, when you make, see, for example, when you make money from W2, you pay tax in a year. And then let's say whatever left, the money is already, you put it, save it in the bank. Guess what? The bank give it to you? Interest, right? The bank give you interest. So at the end of the year, the bank give you a form, normally in January of next year, or the latest about February of next year. They give you a last year 1099 INT, right? So now they not only send it to you, but they also send it to IRS. So the IRS knows you how much interest you earn. If you forget to report it, the IRS will send you a letter. They use a computer to generate. All right. The second way of make money is you put the money in the stock market. You buy like individual stock or mutual fund. Now, by doing so, this money normally receives 2 ways of income. Number one, it's dividend income. For example, like you buy Apple, for example, Apple will declare dividend according to the company. Sometimes do, sometimes don't. But you do have the right to receive the dividend. You buy Apple stock, you hold it, but you receive dividend. You have not been sold it yet, but this dividend income as an ordinary income. You report at Schedule B, B like boy. The interest is in Schedule B, the upper level of Schedule B. The dividend is in the Schedule B bottom. So interest up, dividend down in the bottom of Schedule B like boy. Okay, in the interest and dividend, there's a tax-exempt interest and dividend. Some interest and dividend is tax-exempt in federal, and some is tax-exempt in state. Depends on what kind of situation. All right. Now, when you buy a stock, for example, again, Apple Computer, you buy a stock of Apple company, and then you sold it. Let's say you're lucky. You buy 10,000, you sold it 20,000, you gain 10,000. So if you hold this stock for more than 1 year to sold, so this stock is called what? It's called long-term. That's correct. This stock is called long-term. If you hold this stock less than 1 year to show, this is called short-term. That's right. Now, it's a big deal, short-term and long-term. Which one is better deal? Long-term. You try to get it in the long-term so that you get the better tax treatment. If you short-term, will be treated as your ordinary income, whatever tax bracket you are. You can as high as 30-something% for federal plus state. But if your long-term capital gain, there's only 20%. There's a difference. There's a huge difference. Now, what if you lose money? You buy in 20,000, you sold at 10,000. I hope you're not, okay? So, but let's say if that's unfortunate, you get 10,000 loss. But if this is the only stock transaction in the year that happened, how much loss you can deduct it in that year? Who knows it?
3,000.
Yes, that's right. Even though you lose the stock at 10,000 in that year, you could not deduct in full. You only could deduct for 3,000 per year, but you can carry over. The last 7,000 can continue carry over, and then could be offset for future capital gain. Now, there's one thing very important, and many people do not know that. There is called what sells. What's like what's your hand? What's W-A-S-H. What's. What sells is not a cool deal. How bad deal was it? How bad deal is? Let's say Apple stock again. If today, if I sold an Apple stock, for example, lose money. It doesn't matter how much stock I sold. It doesn't matter how much money is it. Let's say if I lose money for this stock, so normally you can deduct it, right? It's either deduct or carry over. However, if from today, go back 30 days, and go forward another 30 days, which means in a 60-day period, I should not buy Apple stock again. If I do, whatever money I lose it today is not tax deductible. That's called what sells. In another word, when you show something at loss, you got to check yourself back. In the past 30 years, did you buy this stuff? If you do, you probably most likely thinking about is it possible, wait until past the 30-day period. And then you also make a note to yourself, and you should not purchase this stock if you would like to take a tax deductible for this stock losses. This is called what sells. And in my practice, I saw people have what sells, not 10,000, not 20,000, not 30,000. To the point, I saw people have more than 100,000 what sells and loss. And in that year, in their real investment, they lost money, but yet in their tax return, they had to be reported as a capital gain because that 100,000+ is not tax deductible for that what sells. And that's not cool. Do you see it? In that year, you lose money in the real deal. And you have that 100,000+ what sells. And you would not be able to deduct it. And then turn the other way around. Your tax return shows your gain and pay tax onto it. So that we talk about money, make money. We talk about put in the bank, interest. We put in stock. We get a dividend. We get the capital gain. Now there's one more way. You buy a mutual fund, right? You buy mutual fund. There's the money mutual fund in there. Now you may get dividend, and you also get something called capital gain distribution. What is that? The capital gain distribution is like this ABC mutual fund. They buy and sell things. Even though you hold this ABC mutual fund have not been paid, and in that 1099, you have called capital gain distribution. You need to report it. Now, and then if you sold that mutual fund again, that's another capital gain or capital loss. So there's a two deal. But if in the year they have not been sold anything, there's no capital gain distribution. The same thing as dividend. So therefore, okay, so we finish the money to make money in the stock. Recap. What is the bad deal of this whole thing? You got to watch it. When you do stock transaction, what sells? Do not underestimate this what sells. What sells sometimes make you lose a lot of money. Okay, now let's switch topic. Money besides put in a bank, put in a stock, the money you can buy rental property, right? After tax money, you buy a house. To buy a house, you can put full amount, let's say $1 million, if you have it, to buy it. Or you can down payment, like 20,000, but 200,000, 20%, or 30%, 300,000. And then you buy this house with, let's say 30%, which is 300,000. And then you borrow 700,000, right? So in this situation, you have called mortgage. And this mortgage, the mortgage, when you make the mortgage payment, normally in two portions. One is the principal, which is not deductible, but the other is interest. At the beginning of the mortgage, this huge portion is interest. So the interest is tax deductible. You will receive the form is called 1098. Okay, interest, mortgage interest from the mortgage company. They also send it to IRS, and you can deduct it in your rental property. Now, in this house, you also try to keep it up these houses. You have property tax, you have interest, you have repair, you have supply, you have utility, and so forth, so on. All reasonable things. But there's one more thing. It's called depreciation, right? What is depreciation? Well, let's say you bought the house at $1 million. Well, the house combined with two portions of the houses. One is the land, and the other is the structure built on the land. The land is not depreciable. The building does. Okay. So now, if the rental property is rented as a residential, just rented to the person, to the people who live it as for the family. So the depreciation period is 27 and a half. It's not 28, not 27, 28 and a half. Okay. So now, let's say 2 times 27 and a half is 55, right? 27 and a half times 2 is 55. Let's make life easier. Let's say out of this $1 million, there's a 550,000 is worth as a structure, and the 450,000 as a land. Now, we bought the house at $1 million, but what is the depreciation cost basis? That cost basis $1 million, but the depreciation basis for depreciation is 550,000, the structure. And then divide by 550,000 divided by 27 and a half is equal to 20,000, right? Use your calculator. Is 550,000 divided by 27 and a half is equal to 20,000, right? Now, in this situation, and this 20,000, each and every year you can deduct it from the Schedule E rental as an expenses. That's a pretty cool deal. So you can deduct a mortgage, which is pretty big. You can deduct the property tax, and then you can deduct a depreciation. That's why so many times, if you only down payment like about 20-30%, at the end of the day, maybe your net rental is not necessarily positive. But if it's negative, if your income, individual income, is less than 75,000, and you could offset your income. But it's more than that. You cannot deduct it in the current year. You have to carry over. It's called past loss activity. Okay, but as a couple, it's 150,000. What's called past loss activity? Now, each and everything when I talk, I will go detail in the future to talk about. So today is like the overview of the things. And in the future classes, I will talk one at a time and very details. So now in these classes, and some of the people is already have a lot of experience, and some people don't, and some people study about this subject, some don't. That's why I had to go to the very baby stuff. So that way, and levels everybody up so that to the point everybody can from this presentation. All right. So now, since we talk about depreciation, and then let me ask this question: depreciation, is it a tax-free deal or tax-deferred deal? Who knows?
Deferred.
Joyce, or you know it's tax-deferred? Yes, true. Now, depreciation, each and every year you can get deduction. However, in the year of you sold the house, let's say you after you purchase house, $1 million and 550 for the building, 450,000 for the land, you depreciate 20,000 every single year for 10 years. That is 200,000 easy, right? Hey, you're so happy each and every year get 20,000 depreciation against the income. But by the time you sold the houses, it's called depreciation recapture. That means what you have been take the 20,000 each and every year against your income, accumulate together, become a 200,000, will be reported as an ordinary income in the year or you sold the house, and besides other things. And that's a big deal. Now, in the depreciation, especially in the rental depreciation, there is called, and the depreciation in this situation is called, one law is very important, and listen carefully. It's called allow and allowable. What that mean? Allow and allowable. Let's say the law say, like this is situation. As the tax law allow you to take 20,000 deductible for each and every year of past 10 years. If you have take it, great. If you have not take it, too bad. You need to still pay 200,000 as an ordinary income in the year of you sold the houses. And that is not cool. You got it? Alice, do you understand what I'm talking? You do not take depreciation for 10 years, and then you don't get any tax benefit at all. The law says, because we allow you, the law allow you, and yet you don't do it. Too bad. You still have to be careful. Now, is there a way legally can change it? Normally, when you make a mistake, you can do 3 years amendment. But in some special situation, you actually could change it more than 3 years. This is called change accounting math. And in this situation, depreciation is one of it. But you have to go through the special way to doing it. So and then you have to get it's not automatically okay. When you do it, as had to be approved. Okay, but that's still a good deal to do it. Now let's move on. It's for money to make money. What is the other way to make money? The bank, the stock, the rental property. What else we can make money? Well, you can invest the money in annuity. You can invest the money inside the life insurance cash value, right? And you can also invest the money for the business. You can do many things, but for the simple stuff, let's just cover for today like this, but that's not the full list. Now let me ask you this question. What if I have rental property, I sold it, I do not want to pay tax now to Uncle Sam, but I want to do everything legal. So
1031 exchange.
Joyce, right. You're right. If you do so, you can do 1031 exchange. But what if I live in my primary home? I live here for many years, like 10 years plus as my primary home. I bought it, let's say 500,000. Now it's $1 million. Let's say, just for example. It's only me and my wife. 2 of my daughters are grown up. So we can get 250,000 per person for tax-free. Like those 500,000. So in this situation, do I need to pay tax? I bought 500,000, I sold it at 1 million. I lived there for 10 years as my primary residence. We in state of California, community property in here. Regardless, my wife and me, whether or not we join together or just one, it doesn't matter. And each and every one of us have that 250,000. So we just need to report it, and we pay Uncle Sam big at 0. Right. So Joyce, you want to say something?
No.
Great. Now, let's say you're more luckier. 20 years ago, you bought 500,000. Well, 20 years ago, you bought a 500,000 house is very good, right? Now you're so lucky, this house go to not 1 million, 1.5 million. If you sell the house, you gain $1 million. So me and my wife, there's only 2 of us. So we get $500,000. If there's no other people live in this house as a primary home, me and my wife need to pay capital gain at 500,000. 1.5 million minus 500 is it gain 1 million. 1 million minus 50,000, 250,000 per person for me and my wife to get a 500,000. So in this situation, but what if I'm smarter? Let's say I have a twin daughter and who also go into college. When you have a kid go into college, it doesn't matter. It's in around the houses, or you actually maybe in New York or any other places. It doesn't matter. But it's still consider they're living in your home. And this is a special law allow you to do it. Now I'm talking about undergrad, 4-year college. Now in this situation, is there any way I could legally can get a total of 100,000 income tax free? The answer is yes. If me and my wife agree and give 2 of my daughter the ownership of the house, which means in the legal language is add 2 of them in the house as an owner, and they also live on this house as a primary resident, and their driver license, their voting, all the necessary information, and it show is live, and also file tax return if they need to, is in this address as a primary resident. Whether or not they are going to school in your neighborhood, in your area, or outside of California, they're still considered in these houses. If that case, after more than 2 years, the family of 4 each get 250,000, and that's $1 million. That's legal. But if they go to graduate school, it's a different story. They cannot do that. They cannot do that. Or if they have their own primary home, they go to work. If they have their house, and you cannot do that. All right. Now let's switch topic. What I'm going to switch topic is, I'm talking about the money. There's a free kind of money. And a lot of people say, Phillip, money is money. What are you talking about? Free kind of money. Well, one kind of money is the money you make it. You need to report it in your tax return 1040. Tax now. You have to tax in the year you make it. So that's the first kind of money. There's no way you can get rid of it, because you get it, IRS get it, and you have to report it. But if you get a W-2, the only way, one way you can do it a little bit is you may open a 401k, right? So they can deduct it as an income from it, or you can open an IRA. That's tax deferred. You don't need to pay tax onto it right now, but you pay tax on the future by the time you distribute the money out from the 401k or IRA, the principal and interest together as a that year income. So that's tax deferred. Okay, since we're talking about tax deferred, the second kind of money is tax deferred money. You're making money, but you don't want to pay tax yet. You want to pay Uncle Sam later, like 401k, Roth IRA. 401k and Roth IRA, those money, the principal is before tax money. And again, harvest is not paying tax. So therefore, by the time you take it out, it's all tax, principal and interest. And sometimes you hear people say call annuity. What's that mean? Annuity, the principal by itself is after tax money. And then the gain need to pay tax into it. Today, I'm not going to detail this. Now, and then, therefore, by the time you take money out, the principal, because it's the after tax money, you don't need to pay tax on it. You just pay the portion of the gain. Now, is there any third way? I was talking about third way, right? Three way of money, three kind of money: tax now, tax later, tax defer, and tax advantage. What does it mean is the tax law allow you, there's about 5 to 6 kind of the way to put the after tax money in, unlike the tax now, and they actually do not need to pay tax. For example, a lot of people knows it. You have an IRA, and there's another one called Roth IRA. Roth IRA. What's Roth IRA? What's IRA? IRA we talk about it. You put the money in the IRA, you get tax deduction in that year. But by the time you take money out, principal and interest will be taxed. But Roth IRA is when you put the money in the year of Roth IRA, you do not get tax deduction. But here's the cool thing. The principal and interest add together. In the future, you take money out, you're tax-free. That's pretty cool. Which one is better deal? Well, Roth IRA, because the gain in this situation never need to pay tax. But if in the IRA, the gain is also pay tax. For the pure tax purpose, Roth IRA is a better deal than IRA. We have Roth 401k. It's similar like Roth IRA. Now, there's one thing a lot of people miss it. When you contribute money in Roth IRA, and yes, you cannot deduct it, but there is one form a lot of people miss it. It's called Form AAA0. There's a free A. AAA0. But what that form is, that AAA0 form and give you a credit if you contribute money in the retirement account, regardless is 401k, IRA, Roth IRA, Roth 401k. They all have it. So if you forget to fill this form, since the Roth IRA by itself is not tax deductible, so you say, you know what, I don't need to fill it. So you're missing some credit, like a few $100. So you can save this few $100 to go to a nice dim sum, right? You get it. But if you happen to forget in the past 3 years, you can amend it. Okay. Now let's go back to the third kind of money. Is the money will make money and tax-free. And the first one is Roth IRA. The second one, but the Roth IRA, there's one thing you have to remember. You cannot take money out before 59.5. If you do, there's a penalty. So it's the money intended for your retirement and when you get older. Okay, obviously there's some exception for your like first house, and then also like for example, there are some emergency using for the medical, and there is some exceptions. Okay, but in a normal general rule, and there's another one. It's called 529 plan. 529 plan. So what's 529 plan? It's an educational plan. You as a parent to put the money there is after tax money, who make money and pay for the cost of the kids' education is tax-free. But those money in this account have to be directly paid from this account to the school. You cannot take this money back to your bank and then turn around to pay. But it's not. So it's qualified expenses. Now, and then what's the other one? Health saving account. It's from medical. You can deduct it from your paycheck. You can open it for yourself and for your family. So it's not taxable as an income. The gain is not taxable. So it's a good deal. You should go back to ask your boss. Go to your HR and then see if there is such a program for you. If there is, you may consider called health saving account. Now, and then there's another one that the tax law allow you. It's called long-term care. See, when you get injured and you cannot take care of yourself, for example, unfortunately, like 2 years ago, I get to car accident. I cannot take care of myself for long period of time. But luckily, it's good. And I wish everybody have a safety life. Okay. So now, if you need somebody long-term care, take care of you basically. You can either do nothing and then take money out from saving, CD, stock, and rental, but it's after tax money, isn't it? Yeah. But there's another way to doing it is you open a long-term care insurance. You pay for it, and then afterward, when you need a long-term care service, the long-term care service company will pay you money, and then you get it income tax free. And also, the cost of long-term care insurance is tax deductible, and it's called in Schedule A. A lot of people do not know the cost of long-term care, the premium of long-term care, is tax deductible in Schedule A as medical expenses. Okay. What else do we have it? We have one more thing. The money who make money is in the Internal Revenue Code 7702. 7702 allow you under the life insurance. Under the life insurance, inside the cash file, the money is tax deferred. You don't need to pay tax, but the tax benefit is tax free. But you can borrow money against the loan, against it, and then you can pay off the loan by the time pass away. So if you do it accordingly right during your lifetime, when you make money inside the life insurance, does not need to pay tax. When you borrow money out as a loan, doesn't need to pay tax. And all this will pay internally inside by the time somebody pass away, you pay off the loan, whatever left go to the beneficiary. So that eventually, if you buy the life insurance policy with cash value and hold it until you pass away, and this whole thing eventually, if you count it, even include the last event when you pass away, and it's income tax free. So this is what the tax law allow you to do. Let's recap. Tax free. Roth IRA, 529 plan, health saving account, primary residence, long-term care, and life insurance. That's what I normally tell, but there's a lot of people who don't know that. Now today, we're not talking about each and every detail. I just want to give you a broad idea. I start with this class to talk about money and tax. You don't have money, you don't need to pay tax, right? And so I want to teach you all I know it, so that you become a smarter person to deal with your tax and money, so you won't get trapped by this misunderstanding. And that is what I want to do. Now, I take 18 years to accumulate it to this knowledge. And then now I have got to tell you, because when I say it, they all record it and I put it in the YouTube and everybody can watch it. There's many people who have more experience than I do. Maybe they have like their CPA, their master. So I appreciate a lot of people have been help me and teach me. And many years ago, I'm not a CPA. I don't know about that. So I am fortunate to have many people help me in this whole process. So this is the way for me to say thank you to all those people who help me. And I want to share with you. See, I want to take one like live example. Like now, in the past 1 hour, I could just relax, watch TV. But I decided in a week, Monday, Wednesday, Thursday, and Friday, 4 hours in a week to teach classes for free of charges. And last night, I worked until 3:30 a.m. in the morning. Well, why? Because it's extension time. You see, and I also put aside say, I'm sorry, I cannot accept new client for this 2 months because I was too full. And then a lot of people say, what the heck you doing? You don't need a new client for now. And then you talk, but they say, in life is not just talk about, yes, your successful is great. And everybody needs to work hard, successful, take care of family, but that's not all. I want to not only help myself, not only help my family, but also I would like to help others. That's why I involve in Lions Club. That's why I want to share with people. That's why I would like to tell you is there's a guy called Phillip Guan here, but there's many people like me too. And we want to help. If you learn it, you want to learn. See, in Monday, I use Mandarin. In Wednesday, I use Chinese, Cantonese. Friday, I use English. Thursday, I also talk to you how to become the boss. So if you want to learn it, you can come to many classes and you can learn it. As long as my God let me keep going, I will keep going. Okay, take into my plan. I give you a password to my plan. Okay, I give you a password to my plan. Just hang on. Hey, I posted on, but I want to say there is no dumb questions. If you have any question, you're welcome to ask me. Okay. Now, all you need to do, you unmute yourself. You say, "Hi, I'm blah blah blah." Questions, but ask one question at a time. Okay.
Okay. Hi, I'm Iris.
Okay.
So,
hi, Alex.
Yeah. You're talking about Iowa, and the age 59.5. You can take it out. And
Yeah.
what Iowa is any certain year? Yes, you can take it out, or you can take it out anytime.
Well, the law will discourage you to take IRA or Roth IRA before 59.5 years old.
Oh, that means both is the same.
Both. IRS discourage you by impose a 10% additional penalty. Okay. Okay. Now, and then because you're so young, you use it, and then by the time you get old, with nowadays the long life is so long, right? My mother-in-law's 91. Right now, we still keep going. Okay, so I wish her to long life, longevity. You know, so since from a normal 65 to 90, 100, that's many years to go. Okay.
Oh, okay. That means both is the same 59.5 to take.
That's right.
Okay, good.
That's right.
Good.
Okay.
And
okay, one question only. Let other people ask question.
Okay,
Let me okay. And then I if nobody asks question, and then I go back to you. Okay.
Hi, can I ask a question? My name's Victor.
Yes, Victor. How are you?
As the last question, if we pass over 60, how much money we can take out every year without paying taxes?
How much money you can take out without paying tax?
From IRA, yes.
Okay, and this question, nobody, even include me, cannot answer you straight from my brain, my mouth, because it had to put all your number in the software. Yeah, because besides this income, you have other incomes. See, here's the deal. And then each and every person have 12,000 something deductible, all right? Itemized standard deduction. And then if you have a couple, 20 something thousand. But the thing is, you have to use the software to kind of play around in, let's say, for example, you can use 2020 tax software and to assume it your 2021 situation. And then you dump the money, you dump the number in X amount of dollars for if I would take it out and see if I need to pay the tax or how much tax is it. And then you decrease it or increase accordingly. See, this is what, oh, you have one time free of charge, 45 minutes. You can go online, you can book my appointment. Now, because your private situation, I don't want to be like, so everybody knows it, right? So you can go online, pgctax.com, and you cannot book until the 19th of October because from right now, but you don't have to, you don't wait until that day, but by that time probably full. So you want to book it ahead of time for that time, okay? So then I can go, or we can create a dummy number, and then in the future classes I can play around, but it's not the real number, not the real. But we can probably like the social is not a real, all the things is not real, and then we can play around just for fun. But not today. I cannot answer your questions, right? But you remember this question, and you can ask me. And by the time in the future we class it, or if you want to know it ahead of time, you can do it. Now each and every section from A to A30, it doesn't matter what language classes it, you're allowed to ask question in any language, and I will answer it to my best knowledge. Okay, now I answer a question with no answer, no immediate answer.
Okay, thank you.
No problem. So this answer will take some time to do it. Okay. Okay. Any other question?
Yeah. Can I? Oh, sorry.
Yeah, go ahead, Chris. Yeah, go ahead, please.
Okay, thanks. It's me, right? Yeah, my
Yes.
name is Christina. Thanks, Mr. Guan. Yeah, I want to ask one question is about Roth IRA. You said any money you put in, if you do investment, so you don't have to pay tax. And my question is, how much money you can put in Roth IRA, and what kind of the investment you can do? Can you like put it as a down payment?
No, I could. Okay, now let me tell you the answer not only for this question but for a lot of questions. Okay, you should ask me questions that you cannot find it for sure answer. You can find this answer very simple. You can Google it, and you can like 2020 IRA contribution limitation and 2021 IRA contribution limitation, and then such thing. And you can Google it in English. You can get it in even in Chinese or in other language from the IRS website, irs.gov. So this answer, you by doing so, you will save you a lot of time and also assure, because you can go directly from my IRS websites. But I can push a screen out and then show it to you, but it's not worth our time to answer this question for how much. Do you understand what I'm talking?
Oh, yes. Yes. Okay.
I want you to tell me next time, tell everybody the answer. And then you also tell everybody, you tell everybody the next Friday, from 8 to 8:15. I let you talk. I ask this question. I answer you that, and you go online, you search it, and what is the answer? If I give you a fish, you can only eat for 1 day. If I teach you how to fishing, and you can eat for life, right?
Okay, thanks.
Do some homework today. Now remember, hey Iris, remember, Chris, everybody didn't answer next Friday, huh? And everybody can close to along too. So I mean, it's there. And also we have a WeChat group. You can post the answer, we can post question, and everybody can answer it, right? We all put it in there. We are not only connected in these classes, right? We are in the WeChat group, right? So use it. Now, sometimes I want to play dumb so that you become smarter. And I'm not. And a lot of times you know stuff and you don't. Sometimes you don't want to play dumb. Okay, you want to be smart enough to let people don't trick you. Okay. Any other questions? Any other questions? Okay. Any other questions? Okay. We are 9 o'clock. If there's any question, there will be last questions. We already passed 9 o'clock. Okay. It's okay. There's no dumb question. Go ahead. If you want to, if not, and then whoever want to ask the one more time question, you're okay. This will be my last question for today. Okay.
Quan Sang, ngõ hay Joyce.
English, Joyce, English. Today is the English classes.
Oh, okay.
Okay, good. Okay.
And I want to ask, like before you said, like the property tax, if you bought the house as 50,000 and sell it $1,050,000,
500,000, right? Not 50.
Yeah.
Okay.
Yeah.
Okay.
And you add your 2 daughters, and you don't need pay the tax, right? You don't need pay the tax. Yeah, the income tax. And how about if you buy the your like over 55, you can change the property tax?
Well, that's a different deal. Most likely you do, because under Provision 19, yes. Because right now, when we're talking about right now, this class we talk about the IRS. And the franchise tax for California. California tax, the tax authority is called franchise tax board. It's a very interesting name. Now, and then, but between the federal and state, and then below state, there is 2 more levels in the U.S. government. There's a city, everyone knows it, but there's another level. It's called county. In San Francisco, where I live, is city and county together. And the county of San Francisco, there's only one city. It's called City of San Francisco. That's why you say city and county of San Francisco. That's what you hear. But if you go to county of San Mateo, you have city of San Mateo, the city of Daly City, and so far so on. Now, guess who in charge property tax? Not a city, county. But San Francisco happened to be city and county together. But if you go to other county, it's the county in charge that. Yes, you could most likely will get that property, stay it, but you have to fulfill that county requirement.
And how about if later on your daughter move out the name in your in the house, the property tax need to adjust it or not?
That because if you add your name, add your kid's name, is called a gift. Your gift to your kid, and then if you drop it, if your kid give it to you, now would that trigger property reassessment? I'm not sure. You have to check it, because there's a whole bunch of new law, because they just passed it in state of California, and also because of COVID-19, there's a lot of people there's 2B. So I am 2B. I was not my primary job is not dealing with accounting. My job less than 0.1% deal with accounting, and it's all volunteer. So therefore I did not do my homework. So I cannot open my mouth to talk right now to answer your question. I can, both of us can do the homework, and then we talk about that next week from 8 to 8:18 to see who can answer this question, include me together, everybody. Okay.
Do you know what website can search is for? That is the
Just
California.
Google. That's just Google first. But if you go to, if you live in whatever county, you can go to county. But you probably Google, but we go to state of California. But search for the county that you live.
Okay, got it.
Yeah, that's good. That's a good answer. That's a good questions. See, I want to help you to develop a problem-solving skill. The problem-solving skill, that's where can stick with you. Philip cannot be with you all the time, but if you learn how to find your own answer and go through critical thinking, is very important. I want to give you a efficient way to fixing things and find a solution and a critical thinking. But today is the overwhelm. So you may say, oh my God, a lot of things I don't know, a lot of things I know. But for me, because your level are totally different, I am very difficult to teach the classes so make everybody happy. So therefore, some of the people who have experience in this field, you may thinking about two baby. Okay. But I had to do it like this so that level everybody, so that we can build a foundation step by step. But in the future class, I will go to detail. So that way, besides this, if you want to learn more, and you should take tax preparer classes. Tax preparer classes, you can go online. You can, but if you stay in California, you should go into California. You search those classes. Okay, so that way you get it. You get a very formal training, and you can also legally can do tax. But if you study accounting major, you may consider to get your enroll agent. If you study CPA accounting major and have 150 unit, you may consider get a CPA license exam. Now, do you need any college education and experience and license to learn with me? No. You do not require any degree, no experience. I'm looking your will, you're confident. If you have a will, want to learn it, I have a will to teach you. Hang around with me. You'll find, and everything is worth a while. And I also upload those things too. So, and spread out the word, because we're on the Zoom, you can get more people. I want to share this 19 years experience so that can benefit more people. So that way you can benefit yourself. Now, do you guys like what we learned today? Okay.
Yes, thank you.
Okay, you're welcome. Okay, so I'm going to finish these classes and have a great evening. So every week, I do not need to remind you. Okay, every single Friday, the same time, 8 o'clock, we start in here. Get more people, get more fun. Okay, and then in the future, when we have not COVID-19, and then you will have a chance to go to my CPA office to do an intern to learn the hands-on stuff. Okay, and then even though in these classes, I will go to use a software to show you how to input things in detail things. Okay, I also, you will have chance to know everything. I teach you everything that you know that you want to know it, and a lot more. Sounds good? Okay, and have a great evening.
Thank you.
Bye-bye.
Thank you.
Thank you for your time.
Thank
Bye-bye.
you.
You're welcome. Okay,
Thank
bye.
you. Bye-bye.
Thanks, bye.